Good afternoon. My name's Tom Urban, and I have spent a bunch of years in agriculture, partially as an operator and working for Big Ag, Pioneer Hybrid, DuPont. Came to Vancouver to run an early stage company in the forestry genetics world. And for the last about 6 or 7 years, I have been an angel investor really entirely focused on AgTech. Have about 17 investments to date. Am active in about half of them, and just like you guys, or many of you guys, cheering from the sidelines on the rest. So I thought I would spend a couple of minutes just talking about some of the trends in agriculture and some of the drivers in agriculture. And yes, okay, so for the first time, it's better to be in ag tech than cannabis. Okay, I'm very excited about that. Okay, so yeah, as you know, over the last 12 to 24 months, to some degree, cannabis has been sucking up all the oxygen in the investing world. And in fact, in my portfolio, I only have I had one cannabis investment. And I woke up one day and I had 3 because I was in an LED lighting company who was focused on tomatoes and other vegetables, and I got the investor report, and guess what? We're a cannabis company. So this is really, obviously, this is beyond meat, and as you guys can tell, that trajectory has continued. So we may be coming back to the mean here. So last year, this slide, and a lot of this is, there's some really good resources. One is AgFunder, one is the Mixing Bowl, that do a nice job of sort of mapping the ecosystem. And so this was last year, and the message was things are getting complicated. Well, guess what? Okay, so this is the 2019 map, and things continue to get very, very complicated. And there are a couple of observations you can make. One is that ag companies have got to stop using green in their logos because it gets super old. The second is that we're becoming more specific around what companies are and how they are and how they're being categorized. So, you know, we're moving in field monitoring and sensing. And obviously, Semios, Michael Gilbert was kind enough to come on the panel. And this is now the ag landscape, but they've come up with a whole new world, which is the indoor ag landscape. Okay? So not only did it get more complicated, it doubled. And what's nice to see is, you know, there are a few companies. Dave Dennison is going to be on our panel today. He's here. Ecoation is local. Windset Farms is local. And that's going to be one of the themes, is that we should be pretty proud of what we're doing because we're doing okay from the ag perspective. And then the sort of the spectrum of ag starts way back at the technology stage and obviously moves all the way down to the consumer. And that's when you kind of make this move into food tech. And if you thought that ag tech and indoor ag were complicated, well, food and media landscape is absolutely bananas. And so when you think about, if you're an investor, how could you possibly decide where to invest and what is a good investment or a bad investment? And I'll move to a couple of drivers. Okay, so this is not new, and in fact, you know, if we had this conversation 10 years ago, most of these drivers would be exactly the same. So what the big one that everybody always talks about is we got a growing population, which means we got to make more stuff and we've got to waste less. So that kind of runs both gamuts. Obviously, the making more is a productivity. There's lots of technology focused on that at the farm gate. And the waste less is a little newer. So the waste less is, how do we take the supply chains and make them more efficient? How do we ensure that the waste, both at the production level, the processing level, and frankly at the consumer level, is reduced, and there's lots of technology going around that. Profitability. Okay, farms still are trying to make money, and the two drivers for that are, am I going to reduce labor or am I going to reduce inputs? Because we already took care of make more in the first bucket. And we're seeing a lot of effort being pushed in here, and particularly around the labor. So I would say that if I were to have this 10 years ago, that would have been less of a driver. The immigration policies that we've seen, the just general inflation of wages, as an example, in the strawberry industry. What they used to do is they used to bring workers in on a temporary basis, and they used to pay them by the pound, okay? So you have a very flexible workforce, and you're really paying only for productivity. Today, you can't do that. Today, you bring them in, it's very hard to get them in, and you're paying them by the hour, right? When you think about the impact on profitability, and what that says is, here's where I'm looking at all of my robotics. And robotics, if there's a theme, robotics is a very, very important one. And increasing regulation. Novobind, who's going to be on our panel today. Regulation, no antibiotics. Okay? They're being regulated out of existence across the globe. That creates a huge opportunity for companies with solutions. So, in the middle, which is kind of not upstream or downstream, you've got sustainability, traceability, and waste mitigation. They sort of go without saying, and then so I'm going to kind of jump over them. And then here we've got the health, the taste, and the convenience. That has not changed. Right? What's interesting, well, I say it's not. This has changed a little bit. The health consciousness. And what we're seeing is this interesting confluence. If we look at Beyond Meat or Impossible Burger or whatever it is, we're starting to see a combination where I'm getting the taste and the experience that I'm looking for, and I get to be healthy at the same time. So we are starting to try to get our cake and eat it too. So in food tech, the basic drivers are sustainable protein, indoor agriculture, waste mitigation, food e-commerce, and storage and traceability. And again, here in Vancouver, we've got some very, very interesting companies already working and already well on the way to commercialization in almost all these areas. The sustainable protein, you may know Enterra Feed, and Enterra Feed is based out in Langley. They're just opening their new, very large facility in Alberta. Indoor agriculture, Cubic Farms, we'll hear from them a little later on. So again, we are well represented. Food tech is big. I think that's the point of the slide. I'm not going to go through each of them. These markets are very, very large, and it means that when you're looking for investment, for me, whether it's $50 billion or $30 billion or $5 billion, it's big enough. So let's take a look at the investing year, and we're seeing that things aren't really slowing down at all. They continue to accelerate. If you think about, and they've broken it up into upstream and downstream, we've been talking about that a little bit. Upstream, $7 billion, downstream, $10 billion. Very, very large money, very significant investment going in. However, we look at the trend, and again, we continue to rise. Now, a lot of this is skewed a little bit because there are some very big downstream deals, right? So when you look at the biggest part of the investment, restaurant, e-grocer, that downstream stuff kind of pushes it away. What we are listening to this afternoon, and most of what we're seeing is not really in that space. So there's still, obviously because of the numbers are big, there's still a lot going in here, but it's kind of dominated by that downstream. And we're seeing most people, investors, right? Most people do one investment. So we're not seeing huge investments by people. We got some real outliers, S2G Ventures, these are sort of venture capital. But you see most people are in the very, very low, I wouldn't say artisanal, but there's a lot of angel investors and a lot of people looking in a lot of deals. So I just took one of these to give you a sense as to how big these financings are. Right, in the IoT space, and Semios is here today in the IoT space, you can see that a lot of them are not huge numbers. The other thing I'm going to say is that we have at least 2 examples in this year in Vancouver that are going to be the number 1 or the number 2 financings on these charts next year. Okay, that's Terramera and Semios. So there are really important things going on right in our own backyard. And as we just kind of look at what's going on in Canada, this is not necessarily, this is thanks to the NPC folks that provided some slides to give us some context. There are companies really working on those key driver areas, the sustainable proteins, the safety and storage, the e-commerce, and we'll hear from Jessica from FoodMesh, who's going to come in and give us an update toward the end of the day, and waste mitigation. So, and then there have been some significant Canadian investments. So the considerations, I mean, there are lots and lots of them, but cannabis was overriding theme in 2018, but it's slowing. I will say that all of the cannabis, or most of the cannabis stuff, actually was retail driven, particularly obviously on the public stocks. The institutions were not heavily into companies, often for regulatory. The U.S. money was not in those industries, so it had a little bit of an effect, and the drop has cooled everybody a little bit as well. I think we'll still see continued investment growth. The proliferation in ag tech companies continues. 200 incubators, 1,000 new ag techs. There are more investment challenges. For instance, I was out 3 weeks ago in Saskatoon with Nutrien. Nutrien, one of the top 2 ag companies in Canada, has an investment challenge. They took applications. They gave an early stage company $250,000, and they gave the growth stage company $1 million. The growth stage company that got it was Terramera. They just raised 45, so I'm not sure why they needed another $1 million, but they got it anyway, and they did a very good job in presenting. But my thesis is that a shakeout is coming. Now, obviously, with enough time, I can't be wrong, which is great. But in terms of all of those that you saw up on the chart, you can't have 1,000% yield advantage, right? I can't reduce my costs on the farm by 4,000%. So not all of these companies are going to win. In fact, most of them are not going to win. The real question around is who is, and I would submit to you a very simple hypothesis, which is the company that can clearly articulate a concrete value proposition, meaning that I can draw a straight line from my technology to an economic outcome, will win. And you would be flabbergasted by the number of early stage companies that are on that chart that are not able to do that. You know, I'm going to help the farmer with more data. I'm going to give him things so that he can work and improve his efficiency. I don't understand what that means, but that's still rolling around everywhere in the industry. And you know, the downstream is still going to dominate going forward. So BC punches above its weight. I've made this point. Anandia, in the last 18 months, sold for over $100 million to Aurora. Terramera, I think there's at least 1 or 2 representatives, raised $45 million, got an extra million kicker just for being a great presenter. Semios, Michael will tell us a little bit about what's going on. Intera, Ecoation, Elevated Signals, FoodMesh, and this could go on. So we should be pretty happy with what our ecosystem is able to do today. And as a last moment, before I turn it over to my other presenters, last year I gave a presentation and I kind of shared with people what my portfolio looks like and the way that I look at it. And so, you know, red is imminent demise. Yellow is not really much chance of making a return. Blue, or green says maybe, and good says probably. And the only point that I would make to the angel investors in the room is that this is what it looks like all the time. It goes from red to yellow. It goes from yellow to red. It goes from blue to yellow. It's a crazy business. And so if we're not kind of prepared to deal with this volatility, we should not be doing it. But that said, it's a terrific amount of fun, and yeah, you win some.